Today, I want to talk to you about what I think might be the very best dividend opportunity in Canada, one of the most underappreciated stocks out there. And genuinely, if this was an American stock, it would be trading 2-3 times higher. If it was a little bit bigger, it would be trading 2-3 times higher. It's just in that perfect spot that has left it undervalued while still being such a great stock, such a great opportunity, and one of the best dividend opportunities out there from a growth perspective, from a total returns perspective, even from a safety perspective. Today, we're talking about EQB. This is, of course, Equitable Bank stock, or EQ Bank stock, as I'm going to call it throughout this video. It really is one of the best opportunities in the Canadian space. It's overlooked, it's underrated, it's got a pretty cheap price if you compare it to some of its peers, and it has a fantastic runway in the future. Welcome to Golden Arch Investing. My name is Liam. On this channel, we talk about Canadian stocks. If that interests you at all, please do like the video and subscribe to the channel. Today, we're going to go through an article from Seeking Alpha covering EQ Bank stock and why I think they are such a great opportunity from a dividend and valuation perspective. Now, of course, if you are an investor in EQ Bank stock, you probably know a lot of this stuff. You can skip ahead. There are different parts of the video where we're going to cover specifically the dividend. We're going to cover specifically the valuation. We're going to cover some of the interesting products offered. And if you ever want to go to any of those sections, please do feel free to skip ahead. Now, from the top here, we've got an article from the Affluent Tortoise, who I think just has one of the best names on Seeking Alpha here. They have a couple key points they want to make. Great returns since June 2023. That's a 53% return, beating the S&P 500. They got a 20-year track record of consistent dividend payments. They've got a low payout ratio, strong EPS growth. They're targeting 15% annual growth of their dividend, which is going to mean that the dividend doubles by 2030. And they have fantastic products that are coming out that are engaging more and more and more customers, growing to almost a critical mass where they're going to get into that bigger bank space and have just like so much opportunity. Whenever you're going through this, I really love seeing the author's investment thesis. Obviously, both I and the author are pretty bullish on the stock. I wouldn't be doing a video if I wasn't. I personally do own this. I own it in the Large Fund, which is available on Blossom Social. I've talked about it here on the channel. But, of course, this author offers a different perspective, and they've come to the same conclusion. So they might have more insight into different parts of the business that maybe I hadn't been looking at. I think one of the best things this author did for me is help me understand the dividend perspective. Of course, EQ Bank is a great stock. It's a great bank stock. It's a great total return name, but the dividend story here is so underrated. I don't think most investors understand how fantastic this is. And I think in about 5 years, when this does hit that dividend aristocrats list, you're going to see so many more mainstream investors, be they Canadian, American, just like gushing over how awesome the stock is, because they'll finally see it. It'll finally kind of come into their investable universe, and they'll be like, whoa, how did I miss this name? There's a couple interesting things on here. So, of course, he talks about the fact that this is a 53% return over the last 2 years, which is, of course, great. They've got a really strong balance sheet, and really interesting. Hadn't thought about it this way. The space, the mid-sized Canadian bank space has emptied out. We got HSBC that got taken out by RBC. We've got Canadian Western that was taken out by National Bank. And now who's left? I mean, in the years prior, there was a whole bunch of other acquisitions, but at this point, 2025, there's not a lot in the mid-sized banking space in Canada. So EQB has this sort of runway of being like, whoa, okay, well, we got the big six now, right? National Bank sort of upgraded to that top tier. We've got some like smaller players, fintech names, some, we've got all the insurance businesses, but in the mid-cap banking space, it's basically us. And they've used that to their advantage because there's now sort of less competition in that name, in that space. And of course, if you're looking to invest in a mid-cap Canadian bank, your options just got a lot smaller, hey? Okay. Another huge thing, they have a lot of success over the last little bit. They've got a really low payout ratio, and they've committed to growing the dividend. So let's start with that. Ascending to dividend aristocracy. Man, I've mispronounced that every time, but really interesting stuff. Of course, I assume if you're watching this video, you know what a dividend aristocrat is. If you don't, it's a company that has 25 years consistent dividend track record, either always growing or we got some special circumstances with 2020 in there, but basically consistently growing, consistent dividends. They're not cutting it out from underneath you. Usually these come from some of the highest quality companies. What do I mean by that? I mean, it comes from companies that are able to grow free cash flows at a consistent basis year over year over year. You ever see a company that has a dividend chart that just kind of looks like stair steps, like a perfect staircase up? That's usually a good sign, because that means they've been able to just consistently increase their cash flows and basically grow their business in a way that allows them to pay out consistently larger dividends. There are a lot of companies, we talk a lot about commodity companies because in Canada, that's like the story right now. But there's a lot of companies in that space that are offering like, oh, great dividend, the price went down. Oh, great dividend, the price went down. And if you're just a dividend investor, if this is the world you're looking at, that maybe doesn't interest you as much. If you're going to live off these dividends, do you really want to have 1 year where you're a baller and the next year where you're on food stamps? I'm being dramatic, but you understand the point. You don't want income to be dramatically different if you're in it for the income. And as a dividend growth investor, personally, I'm here for the total return, but one day I would love these shares I'm buying this year, the shares I bought last year, to be paying me out. So I like when these businesses offer stable, steady growth. These guys are doing exactly that. They increased their dividend 4.1% in the last quarter, back in February. That's 21% year over year in dividend growth. They now yield about 2%, which you might be saying, oh man, that's lame. But look at this. 5-year yield on cost right now, if you bought shares 5 years ago, you'd be getting 4.75% on your money. On top of that, think about how much higher the share price is, right? Again, it's grown 50-something% in the last 2 years. So not only did you get great share price returns, great capital growth, but also you're getting a great dividend, a great yield on cost. You hold it for another 5, 10, 15 years. Imagine the percentages you're going to be yielding, right? We're going to be talking 20, 30, 40%. And then that's where the real story is, where if you keep investing, keep sort of, taking those dividends, you go for the reinvestment program, you're going to just have fantastic results. One of the most important things that this author points out is that steady dividend growth. We talked about that a little bit, but one of the things that I thought was really interesting on the latest earnings call, the late CEO now, unfortunately, and the outgoing CFO outlined their financial accomplishments, and they had this quote here that you see in bold. They want a payout that reflects our board's conviction to grow the dividend 15% annually over the medium term. And the author has helpfully given us a chart of what that might look like. So you can see the sort of 2024 full year numbers are sort of sitting under $2 there. 25 is going to be just over that $2 mark, they assume. But then just the numbers go up and up and up. We're going to be seeing over $4 in dividends in 2030, which is, again, double what it was now. So over just a couple years, you're going to have a doubling of that dividend. And again, that 5-year story is great, but imagine if that story can just carry on. This is a smaller Canadian bank. They aren't as limited in their ability to grow. They have a lot more room. Again, the space they operate in has basically been hollowed out. The competition has been bought up by these big banks. Now, the big banks are absolutely the sharks in the water here, but EQ Bank has managed to compete with them before and has seen fantastic growth numbers. Why would that change? They're also stood to benefit from any sort of shifts in regulation that make banking more open, mainly because they are a big advocate for open banking, which is this giant system that's supposed to allow all these fintech companies to just dominate. EQ Bank has been literally advocating for that. So disruption is much less of a threat for these guys than it is for the big banks. They're able to grow and grow and grow. They're looking to just continue this going. So imagine what that chart is going to look like when we're talking 2040, right? We could be looking at like mid to high double-digit dividend numbers. So the shares you're buying now that might be yielding you 4%, and that's what, $2, could be yielding you $20 in 10 years. And that's the opportunity that dividend growth investors are interested in. As a dividend growth investor myself, as somebody who's looking at that kind of total return story, looking to reinvest my dividends, I don't need the money now. I want it in 10, 15, 20, 30 years. That's the kind of name I want to own. These guys fit that exactly. The author points out that the dividend growth rate, the compound rate over the last 5 years, is a little elevated thanks in part to the fact that they were not allowed to offer a dividend increase in 2020. But the dividend growth rate over 10 years of 18 is a little bit more accurate. Of course, they're expecting that to slow down just slightly to 15, but that's mainly just a growth perspective. I want to show you guys some payout ratio numbers here. So dividend payout ratio is basically of the amount of money they could pay out, how much are they paying out? Right? That's a very sort of bird's eye view to look at it, but I think it gets the point across. And if you look at the chart here in orange on the far right side, I almost said pink, in orange, you see the average of about 52%. And this is the average of the big 6 Canadian banks. So that's those big 5 I always talk about, plus channel favorite National Bank. Well, you see that the average is at 52. And while there are lots of names that are sitting under there, like National, like Royal, like even Imperial, EQ Bank is sitting at 16%, less than half. So their opportunity to grow that dividend, even if they were not growing their earnings, is still there. So considering the fact they're growing their earnings, they're growing their revenues, they're growing their business at quite a pace, 15% year-over-year dividend growth is not that unreasonable. Even just to get to where some of their peers are at, they could be doubling the dividend, tripling the dividend in the short term. And considering the fact they're looking at that over 5 years, it just shows me these guys are committed to that long-term growth story. Let's keep going down. One of the interesting things here, remember at the top, I said, I want to talk about the dividend. I want to talk about undervaluation. And of course, if you looked at maybe a PE number or even a price to book number, or you're comparing this to some of its peers, you might be like, okay, well, how undervalued is it really? Well, here's where I see a lot of undervaluation. I think that this company is not getting credit, not for what it's doing, but for what it will do. And again, when you're looking at a growth stock, and we don't do a lot of growth stocks here in Canada, let's be perfectly honest, there are not a lot of great growth names. But when you're looking at a growth stock, you're not valuing current earnings or past earnings. You're really trying to buy future earnings. You're trying to guess at how much is that going to cost you based on the next 5, 10, 15 years of earnings growth. And companies that grow like EQ Bank typically have quite a premium on them. And this one just doesn't. And I'm not the only one who's saying this. Look at what's on the screen right here. In January 2025, they renewed and boosted their normal course issuer bid, which allows them to repurchase up to 2.3 million common shares. That's about 8.4% of the float. So let's just round here to some easier numbers. They're buying back about 10% of their company right now. Why would they do that? Now you might say, okay, they're just allowing themselves to buy back shares. But the only reason that they would need not only to renew this, but to boost it significantly is because they think their stock is undervalued. These are bankers. When you think about prudent capital allocators, there's not a lot of names you think before you think of Canadian banks. That's the name of the game here. That's what these guys, that's the bread and butter of what they do, is find the best return for capital. And right now, they think it's worthwhile having almost 10% of their shares available to be purchased by the company itself. How does that compare to last year, you might ask? Well, last year, they allowed for repurchase of about 5%. So they're doubling, not quite, I know, I'm rounding, but they're doubling the amount of shares they can repurchase year over year. Just showing the amount of conviction they have in their name and the amount of conviction they have that the current stock price does not reflect the opportunity. Again, as an outside investor, I love that. You almost always want to be buying alongside management, because when they're repurchasing shares, it's usually because they see the writing on the wall. They know their business better than anyone, and they see that it's undervalued. And again, this isn't some crackpot management team here. These guys are the 7th largest bank in Canada. They are a really very big, very fast growing, really smart name in this space. I'm just really impressed with that. And when you see share price drops like you saw in the last little bit with all the drama and all the questions about Canada's economy, when you see the PCLs go up because they have some loans that didn't work out quite the way they were hoping or whatever it might be, and you see those stock price drops, well, who's going to be buying? I mean, I will. I'm somebody who's going to buy on the dip on a name like this, but so will management. And that gives me a huge amount of conviction that I'm not making a big mistake. I love having the opportunity to buy alongside management. I think it shows some undervaluation. I think it shows that the people who know this business best are aligned with me as an investor. I love that stuff. We got a whole section here where it talks about Q1 2025 results. The one section I do want to show you from here is just above the chart there. Non-interest income. That's one of the things that I think has been a little bit of a maybe not quite an anchor, but definitely something holding the stock back. Because one of the things that the big banks do better than is non-interest income. They've got their wealth management. They've got their capital markets. They've got all of these different arms of their business that aren't dependent on loans. And in an environment like today, where we've got all these big questions about all the risks going on, having a huge business that doesn't depend on loans as a bank is great. But EQ Bank is growing that business really rapidly. I want you to look at the number there. It's the second line down. I'll read it for you here. Non-interest revenue in Q1 2024 hit a new record of 59 million, up 4% from Q3 and up nearly 40% higher than the same period in 2023. The growth in non-interest revenue has grown to represent 18% of total revenue for Q1. So they're growing at a 40% clip year over year in their non-interest income businesses. And of course, it's a range of different businesses, a range of different things they're doing, but it's awesome. And you love to see that as an investor because it shows that they are building in diversification, which is one of the things, again, that makes the big banks such a great opportunity. On top of that, if I scroll just underneath where they have the chart there, their customer growth is awesome. They've got 26% year over year growth, and they're up to 536,000 customers, which is about 5x what they had in 2020. They had about 110 in Q1 2020. So fantastic. Deposits have also grown a huge amount. In 2020, again, it was 2.7 billion. Right now, we're talking 9 billion. So still a significant multiple. And part of that is the product offering. Now, if you're watching this video, I'm almost positive that you consume at least some Canadian financial media. And yeah, that might be on BNN, right? You might be watching the sort of TV media. But I bet you consume at least a little bit more of the digital media, the podcasts, the big YouTube channels. You know, we got blogs, we got, of course, things like Seeking Alpha. Of course, we got lots of Canadian contributors, but all over Canadian media, you've seen EQ Bank, and specifically you've seen them advertising their new products. So I'm sure everybody knows what's on the screen right there, the Notice Savings Account. We've seen this from the biggest Canadian financial names, right? It's on Blossom, it's on the Canadian Investor podcast, it's on all sorts of the big YouTubers channels. We've seen it on all sorts of just general Canadian media. This is a really interesting product, and it shows that these guys are innovating. Not so long ago, the whole point of EQ Bank was they don't have stores, so they offer you a better rate. But now they're showing the flexibility to adjust with the markets. As the other banks started squeezing that space of being like, oh yeah, okay, we'll offer a good rate on this too. And, we got the, Scotia's Tangerine or RBC or TD or any of these groups are like, oh, hey, we're going to offer you this and this and this. EQ Bank said, okay, we got this totally different product, like the Notice Savings Account. They've also launched some USD accounts, which is really interesting. Again, offering a high interest rate because of all the different dynamics there with the US interest rates. They've got some bank business accounts. I think that's really interesting. They got payroll. There's just so much that they're offering to just grow the business in general. And I just love to see it. I love to see them continue to compete. I would have hated to see them not do this. This is a 2024 story. 2025, maybe we'll see even more new interesting opportunities. But as long as we keep seeing those, it keeps showing that these guys are innovators. They're disruptors. It's not just it's not just their challenger bank name. They're literally doing new things in the Canadian banking space. And there's not a lot of companies doing that, right? As a Canadian myself, I can tell you, a lot of it is just a different color on the same kind of website with the same kind of services, with the same kind of rates, same kind of, loan products or bank products or whatever it might be that you're looking for your bank to do. A lot of them feel pretty similar. EQ Bank definitely feels different. And that has attracted a lot of new customers. Again, they're up to 500,000. In Canada, that's not an insignificant number. And with my generation particularly, it's likely to grow faster and faster the more interesting products they can offer us, the more advantages they can give us. And if they adapt with the markets, if they adapt with the times like they have been, that'll grow a lot more. I want to talk to you really quick about risk. think one of the big stories here, when I do a positive video like this, I talk about an opportunity. I think sometimes people are like, hey, well, what about this risk and this risk? And I don't want to dismiss those. But often when I'm doing these videos, a lot of my research does cover the risks, does go through those things, but the stories there aren't quite as interesting. They don't make for such an interesting take. But I do want to read this for you. I'm literally going to go through this word for word because I want to give you a different perspective on risk. I'm biased. I'm sure the author's biased too. But this whole video, you've heard my perspective. I want to give you a different perspective on risk, just in case this ends up being the reason you either do or do not buy this stock. So let me go through what the author says here. They make some good points about risk, and generally I agree with them. So risk analysis. The most significant risks facing Canadian lenders are high levels of consumer debt, an expensive housing market, and a slowdown in population growth. No doubt that geopolitical uncertainty may exacerbate these risks, especially if U.S. tariffs are on Canadian imports, I assume that's a typo, aren't transitory, which kind of looks like they're not. Unfortunately, it doesn't seem like they're going away. I don't know. I could eat my words, and I would love to. I would love to be wrong on that, but it doesn't seem like we're going to get a no tariff world. It's just going to be a constant story. Many borrowers in Canada who locked in low rates during the pandemic are now coming up for renewal. Very true. Those 5-year loans in 2020 look a lot better than they're going to look now. But they're, maybe not as bad as the ones 2 years ago did. There's considerable concern for lenders, especially those with uninsured high ratio loans, that when borrowers renew at higher rates, it will trigger a wave of loan delinquencies. That's why there was the big story over the last year and a half about provision for credit loss, where banks were putting money aside, basically saying, we're not going to use this. We're not going to grow from it or lend it out or anything. We're just going to sit on it in case we lose these loans. A lot of stocks got hit pretty hard for that. But fortunately, 74% of their uninsured single-family mortgages maturing in 2025 are expected to renew at lower rates, barring any new increases. Total provision for credit loss in Q1 2025 dropped to $13.7 million, significant improvement from the $31.9 million in Q4 2024. So you look at the list there, things look better. Value of gross impaired loans has climbed by 12 basis points in the latest quarter, driven by poor loan performance in commercial lending specifically. While this increase is unwelcome, it should be taken in the context of 11% year-over-year growth in AUM. So AUM is growing by 11%. Impaired loans are growing by 12 basis points, so 0.12. In the latest quarter, EQB has made progress on improving its equipment financing portfolio, which is the source of over 70% of their adjusted PCLs in 2024. Loan impairment on equipment lending improved by 34% over the previous quarter. They learned a lesson. They had this one part of the business that maybe wasn't quite as good, and they're fixing it now. For a closer look at their balance sheet, you can check out their previous analysis. And again, it maybe isn't the best thing for video format to walk through a detailed risk analysis like that, but if you've got the time, if you got Seeking Alpha, I recommend you check it out. We got to the end here. So I think at least I have outlined how the dividend opportunities here, there's an undervaluation story here. I think it's an interesting business in an interesting space that offers a different look on Canadian banking. It's why I own the stock. It's why I'm going to own more. But I would love to hear from you. What do you think? Do you like this stock? Do you like the name? Do you like the opportunity? Are you invested in it? Or are there other opportunities you prefer? Are you somebody who can compare this to like a SoFi in the United States? Or do you think it just doesn't fit that same mold? Do you think it's going to ever catch up to one of the big banks? Or do you think that that's just not in the cards? Would love to hear from you in the comments below. As always, if you made it this far in the video, please do like the video. If you like what we do here on the channel, please subscribe. And I hope I see you in our next video.